So good morning, everyone. We are Spruce Land Properties, and we are a consulting group that has been hired by Spruce Land Properties Incorporated to evaluate their current situation and hopefully provide some solutions. So what we're going to be talking about today is we're going to go through some of the goals of the company, then we're going to provide our analysis along with some possible solutions to the issues, then we're going to move along to our recommendation for the problem, and move on to the implementation, followed by the conclusion.
So the goals for Spruce Land is combating social and economic underdevelopment, attracting further investment, as well as partnership opportunities and joint venture opportunities. Also, they want to maximize shareholder profit. The two biggest goals for the firm is combating social and economic underdevelopment and maximizing that shareholder profit. The problem statement is, how are Spruce Land shareholders able to realize full market value for their shares? On the stakeholder analysis, the two main groups I'd like to highlight is the Slave Lake community and the potential investors. The Slave Lake community is high power as they hold a large portion of the shares in Spruce Land, as well as potential investors, because later in Spruce Land, they will help fuel it later on.
So touching on shares a little bit more, like Jack was saying, Spruce Land opened in 1970, private company. They opened at $1 Canadian, and they actually only issued their 65,000 shares to 300 community-based shareholders, which took them 18 months to sell due to the nature of such a small market that they were trying to divulge 65,000 shares into. A little less than 20 years later, they started to pay a dividend, so you can see they're starting to turn a pretty substantial profit. And then now finally, we're going to jump to 2010, where they actually had a stock split of 3-1. So this was vital in the growth of the company because their new opening was now 33 cents. But as you're probably well aware, in around the year 2014, there's a pretty big economic crisis, and it's still somewhat ongoing here in the Alberta oil and gas industry. However, Spruce Land did not wear the storm, I guess you could say, of this. They were trading at an all-time high of $20 a share at this point. As the economy got even worse 2 years later, they continued to rise. So they were rising as the economy that they were working in was falling. And if you look at a graph here, actually, so this was the this blue dot here. That's the 3-1 stock split that we were referring to. Almost instantaneously, their stock price skyrocketed, and the company was able to substantially grow over the coming years. What we see here, though, is the DRIP price. And so what the DRIP program was, my apologies, what the DRIP program was a program for the investors who were the community-based shareholders and the people working in the company to reinvest their dividends at a below market rate. So the rate here was the investment rate that they were able to use versus the actual market rate of the shares.
So we've been provided 3 different solutions by the board. The first one is to dissolve the company completely and cease operations. The second one is to use conservative positioning to take advantage of the current market opportunity. And the third one is to completely restructure the different company. So what we've done to analyze these 3 possible options, we've put them in a decision matrix, which we'll have Mackie explain for us.
Thanks, Jared. So going back to what Jack had previously talked about, shareholder value being one of the main facets of the importance to them. We felt dissolving and taking advantage of their current market position would almost equally provide them that shareholder value and help them realize the full market value of their shares. However, dissolving the company would not align with their goals. It would not help them maintain the social responsibility that the company has founded upon. And it also wouldn't help them attract any further investment, because how can you have future investment if you don't have a company anymore? That's why, taking a look at market advantage here, we see social responsibility. It's a little ambiguous because it's more qualitative. It's hard to say what numbers might turn into in terms of a social impact, but we felt this would allow them a vehicle to continue their social impact. Moving on to strategic alignment, this is going to be a lot more aligned with the goals that they had already set and their future goals as well. And then finally, attracting further or future investment. Our plan will actually have them exponentially attract future investment. So, go ahead, Jared.
So our plan would first entail pausing the DRIP program, which we expect would take approximately 1 month. And we would follow this up by doing another 3-1 stock split, similar to what was done back in 2010. Which will take approximately 1 quarter, 3 months of the company's time. And we'll move that into the property liquidity strategy that we've developed, which will take approximately 3 quarters, we believe. When we implement the Lewins change management model, that is the time we projected for our change to permeate within the entire organization. And then finally, moving that along to a public offering on the TSX. We've projected this to go anywhere from 1 to 3 years because this is a very complicated process, obviously. But we believe that this 4-point plan will cause our shareholders to be recognized for the full market value of their shares.
First step in our implementation is to pause the DRIP program. This was the only approved method of selling shares below market value. This allows shareholders to keep their dividend income and still choose to reinvest in Spruce Land if they would like to. Also, it allows shareholders to have a more diversified portfolio. The second part of the implementation is the 3-for-1 stock split. This will lower the price per share, allowing for greater liquidity and narrowing the bid-ask spread. This will renew investor interest and increase the stock's demand, as well as prospective investors will be attracted to this lower stock price. So as Mackie mentioned, in 2010, the stock price rose 300% with that 3-to-1 split. So we believe, with our projections, at 2016 and onward, roughly 150% increase yearly of the stock price.
So finally, after the 3-to-1 stock split occurs, this is when we move into the property liquidity strategy. And the reason that we felt that the company needed to develop a property liquidity strategy is the board of directors and former CEO Doug Victor had actually really focused on shareholder value and liquidity as being two of the main vehicles moving forward for the company. So we wanted to create as much liquidity as possible, however, also create a foundation for sustainable growth in the future. So take a look at fair value investment property gain here. You can see that between 2014 and 2015, this almost doubled. So the capital gains of the company are quite substantial, especially when you take a kind of deeper look into the economy at the time with it being a recession. Now, if you were to take a look at our cash flow here, this is what I found to be the most interesting and the vehicle that's going to move us forward. So between 2014 and 2015, almost a $7 million jump in cash flow. Very significant, especially during a recession. The reason for this was Spruce Land was actually winding up the company during the boom of the Alberta economy to be able to prepare for the bust that was oncoming. So they were forward thinking and they were preparing for the future. Now, what we propose is that the cash flow is utilized now because Spruce Land had obtained this cash flow to be able to utilize it during this bust. And so Doug Victor had also said, former CEO, who's currently on the board still, that it's a buyer's market, it's a market for action right now. Investment rates are low, capitalization rates are low. So what we propose is a revenue model that can actually match the market. So for instance, let's say in 2016 here, you see cash flow drops out significantly. That's because we're going to use that cash flow obtained to purchase more properties than we sell in the buyer's market, to be able to take advantage of those capitalization rates, to be able to get the properties at their lowest value. And in turn, now when we go towards a seller's market, do the same kind of strategy when the economy was starting to wind up. Increase the level of cash flow by selling more properties than you purchase, because you're selling them when their value is maximized. So essentially, you're going to net the most possible capital gain for the company going forward here. And you're also winding up the realized value of the shares. Because like Doug Victor had said, selling off a certain percentage of the company, not necessarily the company, but the assets of the company, I guess you could say the properties, would really help to build credibility in the eyes of investors as well as potential investors in the future here. And so finally, the public offering on the TSX. It's going to create a significant investment vehicle, and similar to pausing the DRIP program, this will finally close the last door for any undervalued private share sale. You're going to see a larger spike in the market value of shares, and like I said previously, it really increases the credibility, but we also wanted to make sure that you could publicly trade, and there's 4 main things that are going to be needed to jump onto the TSX. First one is liquidity here, and our first 3 steps are to be able to enable this. Liquidity is an all-time high for the company. Second is cost. The cash flow is substantial, cost will not be an issue. Size has actually already been solved because the company had been public previously and they had a special exception of the government where they're not trading on the stock exchange, but the size requirements to become public have already been acquired essentially. And governance is actually the reason that we have the 1 to 3 year period. Because although there is already a corporate structure, we anticipate that there are a lot of checks and balances and things that are going to need to be done in order to iron out the details and meet all the legal requirements as well. So we wanted to create enough of a buffer to still maintain success, but to be able to meet all of these requirements.
Thank you, Mackie. So in conclusion, we strongly believe that in order for our shareholders to realize their shares at the full market value, our 4-point plan of pausing the DRIP program, doing a 3-to-1 stock split, a property liquidity strategy, and publicly trading on the TSX will be the best thing for Spruce Land Incorporated to create a profitable and successful company for many years to come. So we'd like to thank you very much for listening to us, and if you have any questions at this time, we'd be more than happy to answer them.
Can you clarify what you mean by a property liquidity strategy? What exactly would you do?
Absolutely. So I can see where it's a little bit confusing there. The main idea behind the strategy is the, I guess you could say the diversified revenue model, the agility in a volatile market. So let's say it's a buyer's market in 2016. We're taking advantage of that market. Let's use the figure 15%, for instance. We're going to purchase 15% of the current property value additional, and then maybe say sell 8%. So your net gain is to be purchasing property during the buyer's market. But then in turn, you can match when it's a seller's market in the volatile real estate market by selling more property than you do purchase. That doesn't mean that in a buyer's market, you're only buying properties, you're not selling any of them. And in turn, in the seller's market, you're only selling, you're not buying. Because we're also trying to, like Doug Victor said, wind up the value of the share so it matches the actualization of where the market is at. So this is almost a twofold approach to be able to create a strong structure for the company in terms of their liquidity going forward, but also help actualize and realize the full value of the market share.
So this offer that was on the table, you're not going forward with that, or you are?
The offer to dissolve 96% of the assets, is that what
To
you're referring to?
purchase a significant volume of the assets that you have.
Yeah, so we can actually go back to the decision matrix because we had, instead of going solution by solution, we took what we felt, not even necessarily what we felt, but what the board had proposed as the main aspects was most important to the company and went value by value. So we had actually recognized that by dissolving, they would actualize their shareholder value. But it would not meet the other important parts of Spruceland. And the reason that Spruceland has been able to inaugurate themselves, the reason that they came to be in the first place was A, the shareholder value, but also the combating social and economic underdevelopment. And we just did not feel that it would be the right decision for them to completely turn their back on what founded them in the first place.
I guess I'm wondering if you researched how Slave Lake is doing and if you feel that they really are a town that is still requiring this help, because to me, the shareholder value, I think, would be the most important. So I guess I'm wondering, again, if you can just really speak to why you didn't choose solution one, which was to dissolve the company.
Yeah, sure. So the most important thing for that is obviously Slave Lake, especially since the fires in 2011, things have recovered since then, but we feel like this would not be a good time for us to dissolve completely. Obviously, it's still a small town, and we got the feeling that some of the local shareholders and business owners would feel like we would be turning their backs on them, so to speak. Obviously, yes, it would be good for the shareholders, but we feel for attracting further investment and strategic alignment, there is no place to go if you have no company. So we strongly feel like the market advantage is the best way to go because it provides us with the best plan going forward.
And just to quickly add a little bit on what Jarrett was saying there, one thing that we wanted to focus on too is when, I guess it was previously known as Slave Lake Developments, but now Spruceland, when they inaugurated, yes, they wanted to combat social and economic underdevelopment in Slave Lake. But if we can grow the company to a point where the investors are buying in, not just on a financial level, but on an emotional level too, because as we all know, people make emotional decisions justified with logic. So say a company like TELUS, if you're making a financial investment, it's essentially purely going to be a transaction, but a company like this, say somebody in Ontario invests now that they're publicly trading on the TSX, not just somebody, but a lot of people, and maybe Spruceland can have a social and economic underdevelopment impact all across Canada instead of just in Slave Lake. Now you're taking the foundation of the company and turning it into something that not only would be successfully profitable for people that were looking to invest, but something that emotionally would resonate with a lot of people in the climate of today's social responsibility.
Judges, we will take one final question at this time.
I have one about your property liquidity strategy. When you spoke to the buyer's market, I guess what geographical region are you envisioning us picking up properties within this buyer's market?
So previously Slave Lake had focused previously Spruceland had focused mainly on the developments like you had referred to in Slave Lake and the surrounding areas, but due to the nature of being able to trade on the TSX, due to the nature of being able to get more people involved across Canada, the ability to diversify and change your revenue model based on what you're looking at in the market means that we didn't feel like it was a necessity for them to tackle one specific market. they are able to year over year do analysis and go into the markets that meet their goals essentially the best. So let's say they're hoping to buy property in Eastern Canada. Well, maybe in 2016 that's going to be at an all-time low for them, but maybe even though it's in general buyer's market in Canada is specifically Slave Lake, it's not necessarily the case. So you kind of have to look more in depth at the data than the aggregate, because it's easy to look at a in total holistic buyer's market and say, well, this is what we need to do. We're thinking more of a targeted approach where they can find what's going to maximize their essentially shareholder value, but then also still tie back into that social and economic underdevelopment piece that they value so highly as well.
Perfect. Thank you guys for your presentation. We'll give the judges a couple minutes to go over their scorecards, and I'll come grab you guys when they have some feedback, right?
Perfect. Thank you very much.
Thank you.